partially to be a bridge between the pessimists and the optimists. With Larry Summers and others who've been writing about this, the fact that Larry's been looking a little bit about fiscal policy responses, I found to be an interesting opportunity for us in further discussion. What we're going to do now, and we're going to do it before each session, is we have one person on each panel who is going to start off with just a couple of PowerPoints, and then we will come in and wire our entire panel with lavalier mics to come in. But in our first panel of looking at the impact of the unwinding housing and credit bubbles on the economy, we're going to have Simon Johnson, Economic Counselor and Director, Research Department of the International Monetary Fund, start off, and then we'll be joined by David Hale, Chairman of Hale Advisors, former Chief Global Economist of Zurich Financial, Jamie Galbraith, the Lloyd Benson Chair in Government Business Relationship at the LBJ School at UT Austin, Steve Pearlstein, the Economics Correspondent for the Washington Post, and Zachary Karabell, Executive Vice President, Chief Economist, the Portfolio Manager at Fred Alger Management, who has the lead op-ed today in the Wall Street Journal, which I think we're getting to all of you. So let me invite Simon to kick things off at the beginning. And then we'll all take our seats right up here on stage. Simon?
Okay, thank you very much. I'm sorry my voice sounds a little hoarse. These are busy days for the American economy and the global economy. And thanks very much for inviting me. I think this looks like a terrific program. I'm sorry I won't be able to stay with you through the whole day. I think your focus on the US economy and on infrastructure is entirely appropriate and fits very well with what should be top priorities for discussion at this stage in the global economy. Now, I think, and I have 7 minutes to review with you, maybe 7.5 he said now, to review with you the entire global economy. That's fine, I can do it in 6. But it is a short version, and I would be happy to share more details with anyone, and you can also look at my blog on the IMF front page if you want to see more, or if you want to send me comments on what I say. The world economy is clearly in a difficult position right now. It's partly because of what's happening in the United States, but it's also because of what's happening elsewhere in the world. I think you cannot, in my opinion, think about the prospects for the US, and I share Mr. Schwartz's optimism, fundamental optimism about productivity and technological progress in the United States. But I don't think you can really assess our shorter-term likely scenarios without thinking about the interactions between the US and the rest of the global economy. Now, this slide is marked confidential, and this is where the IMF's forecast of global growth is likely to go. It is not, the red line was the forecast we released in October, the full global growth of 4.8% for 2008. I'm not going to tell you the number for completing our revision. I don't yet know it, we're working on it, but you can see from the yellow line, it is lower. This yellow line, to be clear, is my personal opinion. It does not represent the views of the IMF. In fact, why don't you regard everything I say today as my personal opinion, not those of the IMF, unless I say so to Mr. Northwest. The next slide, please. Obviously, at the heart of the matter, and these slides are too detailed to go through carefully with you. I think you know a lot of this. I think other speakers are going to talk about this in more detail. The heart of the matter is what is happening in the US financial markets. And I hope that Desmond Lackman, I'm not sure if he's here already, will share some of his insights. Desmond, who was one of the few people I think who saw some of this coming. But I think even people like Desmond hopefully will agree, he can speak for himself later, that the full implications of what happened in subprime, the way it spilled over across sectors and across countries, has come as something of a surprise. And also the length with which these particular financial market strains have endured, I think is a surprise to most people, Desmond, anyway. Next slide, please. There are good signs. The corporate sector is surprisingly strong. Corporate bond issuances are stronger than you might think. And this is very much related to the themes of this conference. But there are major problems throughout the mortgage market, including in jumbo mortgages, and these are just not going away. Next slide, please. These are problems, and this is what I want to emphasize. I think I have 3 points today. The first point I really want to emphasize is it's not, at this stage, a US problem. You should not think of it as a US problem. It is a global problem. The question is how global, and exactly how people are affected. It is clearly a problem in Europe. I'm used the term Europe a little bit interchangeably with the Eurozone, so and if I had more time, I would pass that out a little bit more. But if you have to excuse me in the interest of time here. You look at bank equity prices. Very similar outcomes we're seeing in the US and Europe. Next slide, please. Look at bank lending surveys. This is really key. We don't yet know exactly how much credit is going to be affected. We don't yet know how much that's going to affect the real economy, either in the US or in the Eurozone. But you can see very similar turns in both data series. This is the one on the right is the European Central Bank, the one on the left is the Fed, which you've heard a lot about, I'm sure. The European Central Bank lending survey is showing banks are going to be much more cautious about their lending going forward. Next slide, please. So this is subprime delinquencies back in the first quarter of 2007. Next slide. This is what they look like now. Looking at the percentage of total subprime loan amount. Again, Desmond can expand on this. And this is clearly the heart of the problem. It is not going away. And I think efforts and ideas being floated by various agencies and by the private sector to try and deal with the heart of this matter are welcome, but we don't yet see how that's going to turn out. Next slide. How much is the US economy going to turn down as a result of what's happening this is showing you the decline in residential investment. Again, it's not clear. Overall, unemployment does remain pretty good, and that's the point made by Mr. Schwartz a moment ago. And there is some good news in the US economy, including net exports, which I'll come back to in a moment. Nevertheless, it is true that in many of the downturns we've seen, it's also true that the structure of the US economy and the housing market, and the interaction between interest rates and housing has changed a lot in the last 30 years. Nevertheless, it is the case that big downturns in housing tend to have or be associated with substantial slowdowns in the US economy. Next slide, please. And again, this is not a US-specific phenomenon. That statement is true in most industrial economies. And if you look at what's happening in house prices in the United States and in Europe, and this actually breaks out UK, Spain, France, all have very similar patterns, all had a run-up in prices. Germany is a little bit of an exception, and that may be a silver lining here. Germany has not had a big increase in housing prices in the last 10 years. Go to the next slide, please. Take any measure of housing-related vulnerabilities you like. Take your preferred measure, take Desmond's preferred measures. Look at the same numbers, to the extent you can, for other countries. And then compare the US to those other countries. Well, the US, I don't know if you can see it on this, I think you have these slides in your handout. The US turns out to be, if you look at housing valuation ratios, a standard measure, for example, look at price to rent, price to disposable income. The US is not among the most vulnerable, it's among the least vulnerable, if you rank countries in that way. If you look at construction investment as a percent of GDP, the US is not the most vulnerable, it's just above halfway. There's a lot of other industrial countries that are exactly as vulnerable. And my second point is, the big mistake everybody made in 2000 was they thought that what happened in the US stock market was the bursting of a bubble in a particular part of a US-specific sector, dot-coms. It wasn't. It was a global downturn linked to repricing of assets much more generally, across information technology and more broadly. And I think it would be a mistake to assume that these problems are going to be limited to the US or just to a couple of countries. Next slide, please. We think the central banks have handled this very well. It's an extremely difficult situation in which to provide liquidity to money markets around the world without upsetting these policy frameworks they've worked really hard to establish in terms of being credible against inflation. We think the Fed and the European Central Bank and other leading central banks have done a great job. But that job is very hard in this situation. Next slide, please. Inflation is a serious problem. It remains. And this is the flip side. The good news is some parts of the US economy are not slowing down as much as you might expect. Some parts of the global economy are not slowing down. In fact, the emerging markets, and this is going to be my third point, is the effect of the emerging markets really critical in this situation. And I'll come on to more details in the next slide, but just take a look at inflation expectations. This is key here. You can try and get at these in various ways. They have hardly moderated since the summer, which is remarkable, given the fact that everybody agrees, all the major central banks, actually, coincidentally this week, have spoken out very clearly, saying there is a credit crunch across the industrialized world. And yet we're seeing surprisingly little moderation in inflation expectations. If anything, there's some inflation pressure. Next slide. It is not only about oil, but it is largely about oil. And I'm afraid that the real risk we face is a confluence of shocks. One is the credit problem, which you're all aware of. The second, you're all aware of if you filled up your car recently with gasoline, is oil prices. Oil prices are high. There is very little, they're high for two reasons. One is there's a lot of demand for oil, and there's been a robust demand and a strong increase, partly from growth in emerging markets, but also broad, strong global growth the last 5 years. There's also very little spare capacity. Reports of large OPEC spare capacity that can be brought quickly into play have been greatly exaggerated. There is some spare capacity in Saudi Arabia. It is sour crude. It is not easy to refine into a form that you all want to put in your cars. This market is very tight. It is clearly vulnerable to supply disruptions. It is vulnerable to fears of rumors of possible supply disruptions. We have not had major supply disruption yet, and yet oil is flirting with $100 a barrel. We'll see. I don't know what the oil price. If you know what the oil price will be next week, do send me an email and we'll talk about it. I don't know what it's going to be. I can tell you this is a serious vulnerability. This is putting pressure on inflation, and it coincides also with an increase in food prices. If I had more time, I could go into that. Next slide, please. It also coincides with other developments, including what's happening in the refining industry in the US, and this pertains to infrastructure. And this is a link between private and public infrastructure. The infrastructure in refining and the incentives that the refining industry has to build capacity. Very important question, and the way in which biofuels are affecting incentives to build refinery capacity is a first-order problem. I wish I had more time to talk about it. It's really very important. It should be front and center of your agenda. It's a macroeconomic issue, right? It's not about anything micro. It's very much macro. Next issue. Next slide. And this has a big effect. I mean, they're all changing oil prices, which are very much related to things that are happening in the dynamics of precisely how the U.S. refineries do and do not operate, as well as what's happening in OPEC. These have big effects, and biofuels. This has big effects around the world. The IMF has 185 member countries. They are all intensely caught up in the same issues as you are, in part because of credit and in part because of oil. Go to the next slide. Now, what I really don't have time to go into is the picture of the balance of global current accounts. The key idea to take away is that while the US part of the imbalance, in fact, the US has a big current account deficit of big surpluses, the US deficit is likely coming down for reasons related to the slowdown in the US and the fact that the housing prices are unlikely to increase further. We expect US household savings to increase at least modestly. So the US is doing its bit, perhaps in unfortunate circumstances, but the US is doing its bit for global adjustments. The surplus countries are not currently adjusting in the right direction, perhaps due to circumstances beyond their control, perhaps for other reasons. Next slide, please. And again, if we had more time, I would go through a pattern of exchange rate adjustments since the summer. It's very interesting and really important, and not, I understand, always the number one item in the US. I understand that, but I really think we have to focus on it more and talk about it more in a constructive way everywhere in the world. The pattern of exchange rate adjustments that we've seen since the summer, and actually over a longer period, I'm afraid to say, does not reflect current account positions. So if you think that there is an imbalance, if you think that the imbalance in the global economy creates a vulnerability, which is what I think, and that is the view of the IMF, then you should hope that many parts of the adjustment process, including exchange rates, would move in a direction that would reduce these imbalances. That is happening in some places. It is not happening in other places. And I'm afraid to say that on the latest data, and of course exchange rates are moving in a very volatile manner right now, in the latest situation, we think the US dollar has depreciated, and that's healthy, and what we've been saying for a long time is consistent with a sensible global adjustment. It is still overvalued in a modest way. I'd say it's on the strong side, relative to its medium-term economic fundamentals. We don't talk about, we're not in the business of short-term exchange rate forecasts and that. We look at 5 years for the medium-term macro fundamentals. The US dollar is still on the strong side. As I speak today, the euro is also on the strong side. That's new. Back in the summer, we thought the euro was fairly valued. Some other exchange rates, including those of China and Japan, are substantially or considerably undervalued, again in the same medium-term framework. What we need is for all exchange rates and all economies to move, hopefully in a cooperative way, hopefully because everyone recognizes their joint interest in this, to move in the same direction. Next slide, please. Again, if I had more time, I would tell you more about emerging markets. Emerging markets are not slowing down. Emerging markets are growing fast. There's divergence in the world. And this, of course, this may be what saves us in this slowdown, because net exports are up in the US. We're selling to emerging markets. The dollar is weakening, we're selling everywhere. But this also is putting pressure on oil. That's also where a lot of the pressure on food is coming from. So a lot of the inflationary pressures is coming exactly from this divergence. And again, I would need more time to take you through what's happening to capital flows, what's happening to investment opportunities, danger of asset bubbles in other parts of the world, and so on. I just flagged that for you as an issue. The last slide is that the emerging markets so far have been surprisingly robust. Even if you take countries that we watch very carefully for some fairly obvious reasons, there have been a bit of signs of stress in the emerging markets. But they've actually, these are the interbank rates, they've actually come through that quite well. So the credit crunch part of the global slowdown so far has actually bounced off these economies by and large. Doesn't mean they can't have problems, doesn't mean there aren't substantial vulnerabilities. But I think that the near-term prospect is that the US slows, the emerging markets are going to actually have a pretty strong year based on capital flows. Now that itself may help us in the next 12 months, but it may lead to further complications down the road. Sorry to have gone over.
Not at all. That was excellent. Thank you. Well, this is time.